Hey guys, Taki here. So this video is probably going to be the most in-depth ICT liquidity guide, and I'm just going to be going over what is liquidity, where does liquidity rest, how do you use liquidity, and just everything regarding liquidity. And let's just get straight into it. So the first point I want to address is what is liquidity? So when we talk about liquidity, it's basically about how many people are buying and selling in the market. So it's just the amount of transactions. So when we talk about a liquid market, what we refer to are like stocks, crypto, bonds, like things that you can easily turn into cash. And when we talk about a illiquid market or just a market that's not liquid, we think about things like vehicles or real estate, because those you can't just easily turn into cash, right? You need to find someone to sell it to, and then there's also a lot of things that you have to do between. So these are markets that are non-liquid. And I mean, when you're just trading ICT, it doesn't really matter if you know what a liquid market is or not, but it's just basically to give you an idea of what it is, right? What liquidity means. It's just liquidity is just basically, the flow of money, right? Because these are called liquid markets because there's a lot of flow of money. Everyone's buying and everyone's selling every second, right? There's a lot of money that is moving. That's why it's liquid. And with these, it's harder to sell and buy, right? You have to go through a lot of paperwork and such. So these are illiquid markets where, there's not a lot of movement happening in the market, right? So when we think about liquidity in terms of trading, it's just basically the same thing. It's how much money is being moved at a certain price level. So for example, if we have this price level here, and then this price level, there's one person buying, right? And then price comes down here, then at this price level, only one person can sell. So if there's a person here, they can sell to this person that's trying to buy, right? But if there's two people that are trying to sell here, then they can't, because there's only one person that's trying to buy. And basically that's just what's important about liquidity. So basically when you think about the larger institutional players, the ones that have a lot of money, that want to trade a lot of money, they need price to move to certain areas where there's a lot of liquidity, where there's a lot of buyers or sellers. So the larger players themselves can, make those bigger orders, right? So that's why we sometimes call these liquidity pools as the draw on liquidity. It's where price wants to move so that, these larger orders can become filled. And that's just basically the basis of, how liquidity works. And so now I'm going to be going over where you can find liquidity and the different kind of types of liquidity. So let's go over swing points first. And a swing point is just basically a 3 candlestick pattern. So if you have 3 candles like this, where the middle candle's high is the highest between these candles that are next to it, then you have a swing high right here. And in the opposite way, if you have 3 candles like this, where the middle candle's low is the lowest between these 2 candles that are right next to each other, then you have a swing low right here. Okay, so if we take a look at an actual example, so let's say we have these 3 candles right here. You can see that this first candle, it has the high right here. The second candle's high is right here. And then the third candle's high is right here. So what that means is that this candle's high right here, this is a swing high. And then right here, we have a low here, a low here, and then a lower low here. So this low is lower than this low and this low. So this would be a swing low. And I'm going to talk to you about why these swing lows and highs are important in a bit. But just remember what they are and how to identify them, because they are basically the basis for how you find liquidity in the markets. Alright, so now let's go on to buy side and sell side. So basically buy side and sell side, it's very easy. A swing high would be a buy side, a swing low would be a sell side. So essentially what it is if the liquidity is above the current price level, then it's buy side. And if the liquidity is below the current price level, then it's sell side. So right here we have the same swing points from before. So we have this swing low and this swing high. And this would be sell side because it's at a swing low, right? And this would be buy side because it's at a swing high. And the reason why they're called sell side and buy side is because, so let's just imagine that you or someone's taking a trade, right? They take a trade somewhere around here and they want to place their stop loss somewhere safe. So where do they put their stop loss? They'll put the stop loss below the swing low. I think that's something that basically all of the trading courses tell you. You know, you put your stop loss below the swing low or the swing high, right? And let's say you have a buy position right here, just like this, and then you want to put your stop loss below this low. Then what do you have right here? You have a sell stop, because if you're in a buy position here, then in order to get out of the position, you have to sell your position, right? So below the low right here, there's going to be a lot of stop losses. And these stop losses for these buy orders are sell stops. And that's why it's called sell side liquidity. And in the same way, if you took a short right here, right, you would put your stop loss above this swing high. And then what you get is that you're in a short position. So you're selling right here and you want to put your stop loss above this high. So you have a buy stop above the swing high. That's why it's called buy side liquidity. All right. And when you're actually trading, it doesn't really matter what you call them. You can call them like liquidity that's above the price, liquidity that's below the price or whatever. But when you're watching videos about ICT and liquidity, then people will definitely call them buy side and sell side liquidity. So I definitely recommend that you get used to these terms and, you know, make sure you can identify them. All right, and then next we have short / intermediate / long-term highs and lows. So a short-term high or low is just basically the same thing that we've been talking about. It's just basically swing points. So like this is a short-term high. This is a short-term low because it's just a swing high and a swing low, right? But an intermediate term high or low it's essentially like a swing point for swing points. So if we take a look at something like this right here, this would be an intermediate term high because you have a swing high right here, a short-term high right here, and you have a short-term high right here. So this intermediate term high or this swing high is higher than the short-term high to the left and the short-term high to the right. So that makes it an intermediate term high. And if we take a look at this low right here, this is an intermediate term low because we have a short-term low right here and we have a short-term low right here. So the short-term low to the left and the short-term low to the right are higher than this one in the middle. So that makes it an intermediate term low. And lastly, we have long-term lows and highs. And I think you can already kind of guess what it is, but essentially we have something like this. This would be a long-term high because we have a intermediate term high right here, right? There's a short-term high right here, a short-term high right here. So this is an intermediate term high. And then on the right side, we have a intermediate term high right here because this is a short-term high. This is a short-term high. So this is an intermediate term high. And then since this one is between these two intermediate term highs and it's the highest between these three, that makes this a long-term high. And right here would be an example of a long-term low. So we have an intermediate term low right here, right? We have the short-term low right here, and then another short-term low right here. So this is an intermediate term low. And we have another intermediate term low right here. So right here is the short-term low, and up here is the other short-term low. So this is an intermediate term low, and then this low is between these two intermediate term lows, and it's the lowest between the three. So this is a long-term low. So next we're going to be going over internal and external range liquidity, and here I'm going to be actually going over how you can use liquidity, right? Some practical application style teaching. All right, so to find the internal and external range liquidity, first you have to define a range, right? So here, let's say that our range is just this right here. And the external range liquidity would be the highest high in that range. So it would be this high up here. And the external range liquidity low would be the lowest low within that range. So this low right here, right? And the internal range liquidity would just be any buy side or sell side liquidity that is between these external liquidity pools. And the way that you can use these internal and external range liquidities is for internal, you basically look for a retracement. So for example, right here, we have this internal range liquidity, right? It's within these two external range liquidities. So we sweep this internal range liquidity, and then we get a move down slightly. And then once we come down, what do? We sweep this internal low, right? And then we get a move up. And then what do? We sweep this internal high, and then we get a move down. And then what do? We get a sweep of this internal low, we get a move higher. And then, you just keep doing this. You get the sweep of the high, then you come down, and then eventually price will move towards one of the external range lows. And then once we break out of this range, once we sweep the external range liquidity, then what does it do? It forms a new range. So once it broke out of this range, right? Once we swept this external range liquidity, then what does it do? It made a new range. So here, what we can do is we can say that our new range can be something like this entire thing, right? So this can still be the external range high, but the new external range low would be this right here. And then our range would be between these two highs and lows, and anything in between would be internal liquidity, right? So what you can see here, if we zoom in a bit, we see we have this internal range high that's made, right? We sweep it, we go lower, and then we sweep this low, and then we go higher. And then what we can see here, we have bullish structure. We're making higher highs and higher lows, right? So we have higher lows, higher lows, higher highs, higher highs. So what do? We sweep buy side liquidity. We sweep these internal buy side levels like here, right? We sweep all of this buy side liquidity, we get a move lower. And then what do? We sweep the sell side liquidity, we get a move higher, right? And since we are bullish right now, what you could expect is we just keep making higher highs and higher lows. So every time you sweep a internal high, you get a tiny move downwards, right? You get a retracement. But once you sweep a low, you get a move higher that is larger than the move lower. So you start making these higher highs, higher lows, higher highs, higher lows. You start slowly moving your way towards this external range high right here. And that's why liquidity is so important, right? Because you can see how cleanly, some of these liquidity sweeps are. Like you just sweep this liquidity and you get an instant reaction upwards. Like this one, it's not so clean. Why? Because it's in the other direction of the higher time frame bias, right? Or just the narrative overall, because what we're doing, we're making higher highs, higher lows, where we have bullish structure form. So it's unreasonable to expect that every time you sweep buy side liquidity, we get a huge move down. But you can see, once we move higher, right, we get this move lower. And then once we sweep the sell side liquidity, since we're bullish, we just get an immediate reaction higher, right? And by being able to master these concepts of liquidity, you can start to see these things form, and you can start to see where the draw on liquidity is, where price wants to draw to, right? And the next concept that I'm going to teach you will give you a huge advantage when it comes to liquidity pools, because these are probably the most important liquidity pools that I use. All right, so we have these time-based liquidity pools. I mean, I just said it, but these are probably the most important ones that I use. I look for reactions off of these liquidity pools. I look for these to act as a drawn liquidity, and it's just so important. So basically what these time-based liquidity pools are, ICT has kill zones, or they're essentially just, sessions that ICT divides the day into. So what do we have? We have Asia, and that is between 8 p.m. to 12 a.m. Right? We have the London session, that is between 2 a.m. to 5 a.m. And then what we have the New York AM session that is between 8:30 to 11 a.m. And we also have the PM session, the New York PM session, which is from 1:30 p.m. So 1:30 p.m. to 4 p.m. And the highest highs and the lowest lows between these sessions are very, very important, right? I'm going to show you some examples right now. So on the charts, I have this indicator. It's called the Futures Exchange Sessions 3.0 by Infinity Trading. And basically what it does is shows you the different sessions. So for me, I have Asia as this kind of yellow color, and then London is this blue color, and then New York as this kind of pinkish purplish color. And what you can see is that the highest highs and the lowest lows of these sessions will hold some significance, right? So I want to show you a clean example first. So I'm just gonna cherry pick a clean example. Yeah, so let's just use this day. It's Tuesday 25th of 2025 February. So what we have these Asia highs and lows. So this is the Asia lows, right? This is the Asia highs, and I mean you can already kind of see how the price is reacting to these highs and lows, right? So we have London highs right here, and then we have London lows right here, right? And I mean, just from this, you can already see how kind of significant these pools of liquidity are. So let's go into Asia session. So this Asia session is what makes kind of the Asian range, and the Asia highs and lows are what we usually play off of, or I mean, at least what I usually play off of. So going into London session, we have Asia high swept, and here we don't have a very good reaction yet, right? We kind of just displace through it and then just kind of chop around for a bit. So this is not the cleanest, but why is that? It's because if you zoom out, right? If you zoom out, we are bullish. So we're making on the higher time frame, we're making, you know, these lower lows, higher highs, lower lows, higher highs, lower lows, higher highs, and we are just bullish overall. So as I talked about in the previous section, if we're bullish, we wouldn't want to expect these highs to do too much. We just want to see maybe a little bit of retracement, but you wouldn't want to, or you wouldn't expect them to just be like come up to the Asia highs and instantly displace downwards, right? Because we want to keep our higher time frame overall, you know, bullish structure. So what do we do here? So we make this London range, we make the London high, the London low, and what you can see here, the London high right here. As soon as the New York session started, we came up to this London high, right? We swept it, and then we got a huge displacement downwards, right? We swept this London low, we got a tiny retracement, and then what you can see here, we swept this Asia low, and then we got a huge displacement upwards. So on the higher time frame, this sweep right here, the London high sweep, was just a retracement. All right, and now you might be wondering, right, why did this, you know, Asia high sweep not work, but this London high sweep works so well? And just why I think that is the case is just because the New York session has more volatility. As you can see here, right, if we zoom out, right, the range for London and Asia, they're a lot smaller than New York, because just the New York session, it's the NASDAQ, right? So the New York session gives the most amount of liquidity, and the London session isn't the best time to trade for at least the NASDAQ, because, you know, NASDAQ is based on the top 100 US companies, right? So you know, it makes more sense that there would be more volatility and more people trading during the New York session. That's just basically why I think this one didn't work as well as this one. So if we take a closer look, we swept London highs, and then we got this instant displacement downwards, and then we swept London lows. We got a slight retracement, and then got a move lower. And this, as you can see here, we have Asia lows right here. And what we can see here, we swept Asia lows, right? And it got an instant displacement higher. So you can just see how strong these liquidity pools are, both as a magnet and as a reaction level, right? So when we're just moving higher, you can see how strongly, price wanted to move towards this, right? And then once it got enough buy side liquidity, it was able to move price lower. And you can see how strongly, these London lows and the Asia lows worked, right? Got an instant displacement downwards with these strong, very strong candles with displacement, right? Got an instant reaction higher, right? A slight retracement, and then got a move lower down to these Asia lows, and then got an instant reaction higher. And I mean, I think that just shows you how strong these liquidity pools are, right? These time-based liquidity pools. And if you're not using these, then you're definitely missing out. You have to be incorporating these into your trading. All right, and then now we're moving on to engineered liquidity. So engineered liquidity are things like relative equal highs or lows, equal highs or lows, and low resistance liquidity. So let's just go through all of these, and these are not very hard, right? It's just basically what it literally says, except for maybe low resistance liquidity. So relative equal highs, they're basically, as the name says, they're just highs that are relatively equal to each other. So these are a good example. You have this high right here, you have this other high right here, and they make, highs that are relatively the same in price level. And these act as strong price magnets, as strong draw on liquidities. So right here, you can see, we came down and then we came up, right? We swept these, or I mean, we only swept one of them, but then we got an instant displacement down, and then, we continued the bullish trend. So these are something that you can definitely look for, right? These are really good draw on liquidity. And for a bearish example or a relative equal low, we can take a look at something like this. So we made the low here, we made the low here, right? So these are relatively equal. They're basically the same. And what we can see here, price came up, right? Made these relative equal lows, and price came down and swept them, right? And these relative equal lows and highs, they aren't the best, I would say, on the lower time frame. Like right now I'm on the 1 minute, but they are very good liquidity pools to use when you can find them on like the 15-minute, and then you can form an entry on the 1 minute based off of the higher time frame draw on liquidity, right? Because that's what you want to be trading. You want to be trading towards the draw on liquidity on the higher time frame. All right, and then next we have equal lows and equal highs. So here is an example of a equal low. It's basically the same thing as relative equal lows, but the lows just have to be at the exact same price level. So right here, what we can see here is that we have these we have these equal lows that we made, right? And then we came up a bit, and then we swapped order flow to bearish, right? So now we were bullish here, but then now we're bearish here. So where can we expect as a good draw on liquidity? These equal lows are a good draw on liquidity level. So right here, you can see price came up and then instantly displaced lower towards these equal lows, right? Once we swept them, you can see how, we wicked back up, right? And as I said, for relative equal highs and lows, these are really good. If you're on the higher time frame, you can find like a 15-minute equal low, equal high, right? And then you can trade towards that direction. Then that'll give you a really good read on the bias and, the overall draw on liquidity for the higher time frame, right? So if we take a look at a bullish example, we have one right here. Right? This is quite an unusual example, I would say, but this counter right here, it doesn't have a wick on the top, right? But this is still considered the high because, this is the highest point of the candle. And then we have the high right here. We make these equal highs, right? We come down a bit, we retrace a bit, we sweep these equal highs, right? And then get an instant reaction lower, right? Like you can right here, you can see how cleanly these equal highs were respected, right? So I mean that just shows you, right, how strong these liquidity pools are as, you know, both a price magnet and a level of reaction. And finally, we have low resistance liquidity. So low resistance liquidity is just basically kind of, I guess you could think of it as either a trendline liquidity or just consecutive relative equal lows or highs. So right here, what do we have? We have a bunch of these lows right here, and they are relatively equal, I would say, right? And these make low resistance liquidity. So once price comes down and it runs one of the liquidity pools, then you can expect price to just spool lower and run all of these liquidity pools at once without having, you know, large retracements or anything, just a fast liquidity raid downwards when you have a low resistance liquidity on the bottom side. So right here you can see we came down and we got a bit of hesitation right here, but you can see how we got this rapid displacement lower. Like there's no up close candles in this run right here. And that's just how these low resistance liquidity levels work. You know, you just get these rapid price levels or these rapid price movements. And that's why they're so good to use as, you know, draw on liquidities. And here's a bullish example. And also I'm going to show you a different way that you can identify these levels. So as I said, they're basically trendline liquidity. So if you can draw a trend line, right, and these highs or lows just keep touching the trend line, then that's just basically low resistance liquidity, right? And as you can see here, we came down, we swept the sell side right here, right? We re-swept the sell side right here. We got a move higher, and then we came down once retraced. And then you can see right here, once we came into this zone of low resistance liquidity, we just instantly sped up, right? And then we came all the way up here and towards this buy side liquidity. And I mean, like just with this example, you can kind of see how, you know, these levels of liquidity just all tie together, right? Because you have this sweep of sell side, right? So right here, you have another sweep. So a sweep of sell side comes up, right? And then comes down, sweep of another sell side, you know, get a slight retracement, swept the sell side for the third time. And then now we get a switch in order flow. Now we're bullish, right? We sweep these low resistance liquidity. We get this rapid expansion higher, and then we draw towards this level, this buy side liquidity level. And then what do we get? We get a retracement, right? Right, because we swept this buy side liquidity, now we need to go lower. We need to, you know, get some sell side liquidity now, right? And then what do? We go lower. We just keep going slightly higher and higher, slowly, right? And then what do we do? Okay, what do we see here? We see this low resistance liquidity again, right? This one's not as clean, but I would still consider this low resistance liquidity. And then what do we do here? We just get this rapid price expansion upwards. And then where do we draw to? We draw towards the buy side liquidity right here, right? And once we sweep this, what do we get? Then we get a move lower because this is external range liquidity, right? So within this entire range right here, where is external range liquidity? This is the external range buy side, right? And then so we sweep the buy side, get an instant reaction down. And I mean, this is just, it's so clean. It works so well. And if you understand liquidity, you can literally just see and predict where the market wants to go before, you know, the move even happens. And that's why, you know, learning liquidity, it's the most basic thing about ICT, but it's also the most important thing. All right, and then now we have liquidity voids. So liquidity voids are basically just areas in price where there's a huge imbalance in the market, right? Price moves really bullish or really bearish, and it creates a huge gap in the market. I mean, I think it's easier to see an example. So let's just get straight to an example. All right, so here I'm on the 1 hour, and you can see these 3 down close candles and how bearish they were, right? We made this huge gap right here, and that would be your liquidity void. And when you use liquidity voids to kind of frame a bias, or, you know, if you want to use a liquidity void to understand where price wants to go, you would expect these liquidity voids to get filled, right? Or at least, rebalance to around 50% of the range. So if we draw this out, we have the liquidity void right here. And what do we get? So on the way down, we make this liquidity void, right? And then we slowly start moving up. We fill the entire thing. We trade through the entire thing, right? So on the way down, we make this liquidity void, right? And on the way up, we just slowly go up, right? And then we trade through the entire thing. We wick above. We don't actually close above, but it's fine because we traded above. We traded through the entire liquidity void, right? And then now what do we get? We get a move lower, and now we get a move higher again, a slow move higher again, right? And then we start to kind of just balance this price range because the market wants to be efficient, right? When we make this liquidity void initially, there's only sellers in the market here. We want both sellers and the buyers, right? Because the market wants to be in equilibrium and wants to be efficient. So we want buyers to come in, and the only way they can do that is if price moves higher and all these sellers in here are willing to actually sell at a price, because the price needs to be high enough so that the sellers and the buyers can both reach an agreement. If the price is too low, then the buyers would be happy but sellers wouldn't want to sell. If the price is too high, then sellers would be happy but the buyers wouldn't even want to buy, right? So we need to kind of be in that equilibrium, the midpoint, right, where both the sellers want to sell and the buyers want to buy. So that's essentially what we're just doing here. We're rebalancing this price level so we get efficient movement in the markets. All right, and then before we move on to liquidity sweeps and runs, I just wanted to mention data highs and lows because these are also very important liquidity pools that you can use. So data highs and lows are basically if you have a high impact news, right, and it creates these large wicks, the highs and lows of those wicks will be a very good and important liquidity pool. So for example, what we had here, so this is Nvidia earnings, and usually earnings don't affect the markets too much, but with how large Nvidia is, of course, it just makes the market go crazy. And if we mark out the high and the low here, you can see something form, right? So we have these data highs right here, right? We get a slow grind higher towards the data highs. And then once we come above, we wait until it's New York session, right? So New York session opens at 9:30 a.m. That's when the actual stock exchange is open. And then once the stock exchange opens, what do we get? We get an instant run lower towards data lows. And I mean, this is just crazy how good these data highs and lows work. Like you just sweep these data lows and then you go for a bit further, but then you get a move higher because we swept all of the sell side. We don't need to take any more sell side, right? So these data highs and lows, they work very nicely. Make sure that you guys incorporate them into your trading. All right, and then lastly, we have liquidity sweeps versus liquidity runs. So a liquidity sweep is when you go towards a level of liquidity and then you get a reaction to the opposite direction. So right here we have sell side here. We come down and we get a reaction towards the buy side. So that's a liquidity sweep. And the liquidity run would be something like this right here. So we have this swing low, the short-term low, short-term sell side. We trade towards it, but instead of getting a reaction higher, we just completely displace through it. And basically the way you want to differentiate between liquidity runs versus liquidity sweeps are if you actually get a reaction off of the liquidity level. So it's not something that you need to predict. It's just something that you can kind of look at it, see it, watch it play out, and then make your next decision based off of it. But I mean, definitely there are ways you can kind of predict whether it will be a run versus sweep, which I will talk about in a bit. But a run would just be huge displacement above or below that liquidity level. And what does that tell you? It just tells you it wants to keep going in that direction. For example, if we have this here, this is a liquidity sweep, right? You can just watch this play out. So, let's say you're watching, right? Price comes up, right? Sweeps this buy side level and then it gets this reaction downwards. So right here, or at least by the time you're like down here, that this was a liquidity sweep, right? And then now you can start looking for trades towards sell side. And right here, if you were actually on the charts trading, right, watching, then you wouldn't have to predict whether this will be a sweep or a run. You can just watch it, just be like, okay, so there's sell side here, and then let's say if this was a sweep, then I'll take longs here. But if this was a liquidity run, then I'll take shorts here. So what you could have done is you could have just waited until this candle closed, right? You see this huge displacement lower, and then in the next couple of candles we don't go straight back up, so that means this was a liquidity run. And then now you can kind of frame any shorts that you want. So maybe you can enter off of this fair value gap right here. But with a liquidity sweep, so let's say, okay, this is a very nice liquidity sweep, right? Here, liquidity sweep. So you were waiting, right? Price comes down, you wait for this level to get traded into, and then once we come into this level, you can see we got this instant reaction, right? And then we started displacing higher in the opposite direction. And then what do we see here? We have like a fair value gap right here that you could enter longs off of. You also have a BPR right here you could enter long off of, right? And then after you see whether it's a sweep or a liquidity run, then that's when you can trade, right? That's when you can, form your idea, right? That's when you know which side you want to trade towards. Basically, the way that you kind of predict whether it's a run or a sweep is if it's external range liquidity, then there's a good chance that it's a liquidity sweep, right? If it's internal range liquidity, then there's a good chance that it's just a liquidity run. But also you have to keep in mind the higher time frame bias and just what we're doing on the higher time frame. So if we're making higher highs, higher lows, higher highs, higher lows, then you would expect the highs to be a liquidity run, right? And the lows to just be a liquidity sweep. But if we're going lower, if you're making lower lows, lower highs, lower lows, lower highs, then you would expect the sell side to be liquidity runs and the buy side to be liquidity sweeps. Like right here, this is a really good example. We have buy side here, we sweep it, we come up into it, instantly displace over. We have sell side right here, we run through it, it's a liquidity run. Why? Because we are bearish right here. And that's essentially just how you can try to predict whether it's a liquidity run or liquidity sweep. And as I said, you don't have to predict it, right? You can just wait for the play to form after the sweep or the run. So you can just wait for the liquidity run right here, enter off the fair value gap. You can wait for the liquidity sweep right here, watch the reaction, enter off this fair value gap. So you don't have to predict it per se. And that was it for the video. Thank you guys for watching. If you do have any questions, then make sure to join my Discord and just talk to me, right? Just send me any questions you have, and hope you guys have a good time trading.